Hi, this is James Eng of Old Capital. And in this update for December 2022, I'm going to go through definitely some macro stuff in terms of interest rates and the Fed, but then also jump into where we're seeing opportunities for buyers and then potentially how to structure those deals appropriately so that you can win in all environments. So a lot of people are asking us, we do over $1 billion a year of multifamily financing at Old Capital. And a lot of people are asking us which way our interest rates going to go. Are they going to go up? Are they going to stay flat? Are they going to come down? And the best answer I can give you is I don't know, but you have to position yourself to win in all three scenarios. And so what does that mean? We're going to walk through some scenarios where if interest rates continue to go up, or even if they stay the same, like essentially this flat, are you going to be able to win? Are you going to be able to survive monthly at your property? So let's go through some of the stuff. Even so, we've had both of these guys at our speaker series. Casey Conway recently posted this, and he's thinking that we might continue to see 50 basis point hikes in Q1 and Q2 of 2023. Right. So they just had a hike of 50 basis points here in December, and now another 50 potentially in Q1 and Q2. So you could be seeing, 7% federal funds rate next year. Right. And so the market's not pricing that in. And, another guy that we listen to a lot is JP Conklin, and he's betting that it will not get to 7%. Right. So he's thinking it's going to go with the market probably around 5%, top out about 5.25. But the thing is that really nobody knows. Right. And even if you listen, I just listened to the whole, Jerome Powell going through his question and answer session and reading his statement, and he doesn't even know. Right. Because inflation has stuck around. It's come in a lot stronger this year than anybody thought. And it sort of has lightened up here in the last month or so. But the things that are impacting it, right? So when they look at inflation, they're looking at sort of the normal goods inflation. They're looking at shelter inflation. And then they're also looking at job or wage growth inflation. And here you can see on the bottom left, wages are still growing a lot. And so until I think that makes up about 55% of the inflation reading that the Fed uses, if that's still high and that stays stubbornly high, then it's going to be hard to bring inflation down from, we're at 7%, bringing it all the way to 2%, which is what the Fed's mandate is. And so if you look at what the market is pricing in, I like to look at this Fed Watch chart, but basically the probabilities here, most people are thinking 25 basis points on the next two meetings, and that gets you to around 5%, and then holding it there for about 6 months. So March to September, and then potentially cutting towards the back end of 2023. Nobody knows though, right? So all of next year, you could essentially be sitting at a 5% federal funds rate or SOFR. And when SOFR is at 5%, your spread, most deals on Fannie Freddie are about 250 over, and then on bridge you're anywhere from 350 to 450 over. So you're anywhere from 8 to 9% on your interest rate if you do not have a cap, and so that is exceedingly high to maintain that position for a long time when you bought deals at 4, 5, 6% caps. So we're having to sit here and wait, and so when we go back to this is what I'm going to come back to, is that you have to position yourself to sustain an interest rate at that high of a level. And if you only win when the rates come down, then you're in trouble. So position yourself to win in all three scenarios. And, there's a lot of historical data around when they're going to cut. I've shown you this before, is that usually it's about 2 years on average, and usually it's about 9 months from the last hike to the first cut. So all of that data is averages, right? And so that basically puts you at, Q1 of 2024 for the first cut. And so that's what everybody's using. But in reality, nobody knows. And so you have to position yourself to win in all environments. The current forward curve is going to have it essentially being flat, maybe end at 2.5%, 3% SOFR. But historically, they almost always cut faster and steeper downward. And so you have to sort of look at that and say, all right, well, we've got to get there, but you've got to survive on a property level before they start cutting. The one thing that is been positive, I would say, over the last 30 to 60 days is 10-year treasury has come in significantly. And so a lot of people are looking at 10-year treasury and saying, look, it's 3.46, 3.45. I just pulled this week, compared to SOFR now is 4.25 to 4.5. And it really doesn't make any sense. The long end of the yield curve is lower than the front end. And so I wanted to show this chart. So this shows the treasury yield curve. And, in 2020, it was essentially flat for the first, the front end of the curve all the way up to the 30-year. It went from 0 up to 2%. 2021, it was at 0, went up to 2%. So that's the normal curve, right? And right now, when you look at the treasury curve, this keeps getting pushed up by the Fed. So the front end of the curve keeps getting pushed up and pushed up and pushed up by the Fed. And the Fed really reflects, is pretty close. The federal funds rate is pretty close typically to the 1-2-year treasury. So right now that's, let's say 4.5, 4.25 to 4.5. And then the 10-year treasury is sitting at 3.5. And you're saying, like, I've tried to explain this to a lot of people, and it doesn't really make any sense. And you're trying to explain to the market, like, why would somebody, buy the, let's say, 2-year treasury at 4.5, or why would you buy the 4.5 versus buying the 3.5? And the reason is, when you buy that 4.5%, you get that for 2 years, right? And after that, you have to go out into the market and buy another rate, right? Buy another, let's say, bond, let's say another treasury. And most people are thinking that at that time, you might have to come in and buy a 2-year treasury. If the Fed cuts rates hard, then you might have to go buy a 2%, right? And so that's why people are still buying this 3.5% treasury, because they're expecting 3.5 for the next 10 years, right? So on average, they think that will be better than buying a 4.5 today, and then in 2 years having to go out and buy, let's say, a 1% or 2% treasury for the remaining 8 years, and the yield will be better. And so in terms of 10-year treasury, where people are forecasting it right now, it's about 3.5 right now, and then they think it's going to start coming down next year, right? So that's their forecast, and then hopefully stabilizing around 3% by the end of 2024. All right, so a lot of people are asking us, like, is now the time to refi from a floating rate? So it might be a floating rate Fannie Freddie, it might be a floating rate bridge over to fixed, right? And so I wanted to walk through some of the pros and cons so that you can make a decision as an investor, right? So the first pro, obviously, is you fix your payment, right? So you know exactly your interest payment. Most of these deals, if you bought them, let's say in the last 2 or 3 years, you're going to have positive cash flow on a monthly basis once you fix the term. And honestly, when you refi to Fannie and Freddie, they're going to have a 125 cover on your debt service cover, so you should have positive cash flow. You're going to extend your loan maturity. So majority of these deals, especially on bridge, they're usually short term, 3 years, but Fannie and Freddie are usually 5, 7, 10-year terms. Right now, you're escrowing for interest rate caps, so that's a monthly thing, and that's going to go away once you go to fixed. You'll receive your current interest rate cap escrow funds, right? So whatever you've been putting into the lender for the last 18, 24 months, and then you can sell your rate cap. So most people don't know this, but you can actually sell your rate cap. Let's say you bought a 1% strike and there's 12 months left, you can sell your rate cap for a gain. The cons, obviously, are that your monthly debt payment will probably go up, If you have a rate cap, let's say your strike was 1% and it's SOFR plus 270, you might only be paying 375 right now, right? So if you actually come up, then to 5.5%, your interest rate is going to go up, and thus your payment's going to go up. So you might have a higher monthly payment, and then you might have a higher prepayment at sale, right? So majority of fixed rate deals, they have either what's called a yield maintenance penalty or a step down prepayment penalty. And so you're going to have a higher prepayment at sale in comparison to most floating rates have a 1% exit. So let's look at, this is an example of a deal. Here's the NOI that was sort of pro forma over the first 3 years. Here is the SOFR plus the rate cap. So rate cap was 1%. So they were paying 372 on an annual basis, 3.72 on the interest rate. So their payment was only 773. And here's their interest rate cap escrow in year 1 and then year 2. So it went from 2,000 a month to 30,000 a month, and now it's going to 100,000 a month. And so in year 3, the net cash flow for the property after making not only your interest payment, but then your rate cap escrows is a negative 447,000. So most people, some people have that at the property level, other people do not. And so if you do not have that money, the general partners are going to have to come up with that money on that floating rate loan. All right. So let's see. All right. So they're coming up on year 3 right now. So they're looking at this exact decision. So refinancing to a fixed rate. So you have same NOI, but let's say your debt payment on 6% IO, it goes basically from 1.5 minus to 1.2. So your net cash flow is 275,000. And then you can sell your rate cap. So this rate cap still has about a year on it. So you can sell that rate cap for 600,000. So net in terms of year 3, instead of spending or putting out 447,000, you're gonna the cash flow is going to be 278. Plus, you're going to sell that existing rate cap. So this could be a swing of about $1.2 million in your cash position at the property, right? But the con is that you will have a higher prepayment at sale. So let's flip over to the next slide and show you this in a little bit more detail. So assume most people, let's say that they usually have a 5-year hold on these deals, and right now they've been in the deal for 2 years, and now they're sort of going into year 3. So we assumed sort of a year 6 exit, and we're going to assume a prepayment of 4%. So if you do a step down prepayment, it'll start at 5% and then it'll go down. It'll go 5.5, 4.4, 3.3 as a percentage of the loan amount. So we use 4% of the loan amount here as your prepayment. And then we also made the assumption that you would still have to buy a rate cap for years 4 or 5 for your property. So you bought the rate cap, and then you're also going to have to escrow for a rate cap in year 6. So based on all of that, we looked at this deal and made the analysis and decided that it's probably time to go to refi to fixed. When you're doing this analysis, and I can send you the spreadsheet so you can plug your deal into, but the interest rate cap cost. So this is going to be really based on where SOFR is at the time. And then also the prepayment on fixed. So we know this prepayment because it's on a step down, but if you did a yield maintenance, this prepayment could be higher, right? So you have to look at your total cost, sort of interest plus rate cap plus prepay, and then compare that to the actual cash flow that you're going to get. So in this scenario, on the floating rate basis, we're closer to 5.7 in cost, and then cash flow was about 500,000. So you're about 5.2 million in net cost on the float. And then on the fix, you're 5.8, and then you're getting about 2 million in cash flow plus your rate cap. So you're about 3.8. So on this deal, we're looking at a fixed, and then plus you just have that sort of monthly cash flow that if the floating rate did run away from you, you wouldn't have to worry about it because you have a fixed rate on this property. All right. So another reason to look at potentially fixing right now is that a lot of people have done pretty well on their properties, I would say, in the last 6 months in terms of rents, in terms of occupancy, in terms of collections, right? But when the Fed typically raises rates this high, there's a lag effect between when the rate cuts happen and unemployment. So if you look at this chart for Pinsford, as rates sort of, they stop hiking rates, then usually unemployment takes off, right? So if we anticipate sort of rates to stop hiking, let's say in 2023, and then we're going to see unemployment go up. So this is probably a better example. So they stopped the rate hikes here, unemployment took off. They stopped it here, unemployment took off. So we're going to probably see once they sort of stop the federal funds hiking, then we're gonna see unemployment. It might go up from 3.7 to 4.7 to 5.7. We don't know. But if unemployment goes up, that's going to impact the demand on these properties and also so that's going to impact occupancy and rent growth. And so your NOI might actually be lower. So when you go to refi, it might be harder. So that's what we're seeing a little bit already right now. I mean, there's a lot of news about a recession, so people are sort of pulling back a little bit. So the demand has not been as high. We're seeing sort of on a national basis, rent growth decline year over year. And then also we're seeing cap rates move up. So we're not seeing as many transactions in terms of deals trading. But, if you look at, I'll just highlight a couple of markets here. You look at Austin, this is moving from 4% to 4.6%. You're looking at Dallas from 4.4 up to 5%. And then some of your smaller markets here, San Antonio over here, this is going up 70, 75 basis points. So, I mean, this is just quarter over quarter. So we're seeing the expansions happen. I mean, not every deal is trading, but, for the deals that are trading, they are at higher cap rates than where we were in the second quarter. I pulled some emails and, this is some of the deals that are on the market. People are staying in deals. So sellers are staying in deals, whether it's helping with the financing, whether it's helping with staying in as LP. Sellers are staying in deals right now to get their price. Another thing is that a lot of buyers are just doing loan assumptions, right? So this has 10 years left, assumable 3.5% interest rate. I mean, market rate for Fannie and Freddie right now is closer to 5.5. So to get 3.5 on 10-year financing with, let's say inflation stays high for a while, I mean, this is going to be an asset, the debt that you assume. So we sort of spent some time on the economic and multifamily side. Let's jump into the financing side. So my background, I was born and raised in Houston, went to school at UT in Austin, and then have been up here in DFW since 2006. And started as a loan underwriter for GE Capital for 10 years, and then moved over to the multifamily side with Old Capital in 2015, and have invested in numerous properties throughout all 4 metros in Texas. So, we touched on this at the beginning, but you really want to be able to weather any storm in terms of interest rates going up, flat, or down. And a lot of people that we're talking to right now, they might have to bring some cash to these refinances. So whether you're on a short-term bridge or if you're on an agency loan with a floating rate, you might have to bring some additional cash. And so I think 2023, I've called a couple things, but 2023 is going to be the year of the refi, the year of the loan assumption, and the year of the capital call. So the capital calls are coming. So prepare yourself if you're an LP. And then as a GP, if you can avoid doing a capital call, sort of pulling back on distributions now, I think would be prudent. And then we'll talk about some of the opportunistic purchases coming up. So a lot of people are still definitely looking at multifamily in comparison to almost every other asset class. It has its leases reset annually. The affordability of single family has gone down significantly. Pricing's down 20%, let's say, on multifamily compared to beginning of the year. And then new construction is definitely going to be lighter. And then you can still get lending through Fannie and Freddie. Working on the cash flow of these properties is important. So you've got to buy for cash flow. And then, when I started, a lot of people were looking at double-digit cash on cash. So I'm hoping for that to return at some point. All right, so here's a snapshot of a software program that sort of feeds us data, and these were some of the things that they mentioned. So assumable debt, loans with 5 to 7 years. So there's 3,000 deals out there right now. Acquisitions with short term, so bridge loans, so 2,500. Floating rate loans, 3,000. Construction loans, 400. Watch list items, and then debt service below 105. So 2,500 in that space. So there's a lot of opportunity out there. It's going to be right now, the sellers don't have to sell, but if rates stay high, they might have to sell some of these deals right away. All right, so here's an example. So we'll talk about one of these bridge. Some motivated sellers who they have floating rate loans and shorter terms, but they might not have an interest rate cap. The bridge lender might start doing cash flow sweeps, and then they might not qualify for the extension, and then they might have to purchase new interest rate caps. So there's all these things that could potentially pop up on a bridge loan that if you're not prepared, then you're going to have to sell the property or do a capital call to get more money. Another thing is these floaters. So Fannie and Freddie have floaters, and essentially what you have to do is you have to escrow on a monthly basis the same way that you have to escrow on property taxes, insurance. So on this one, for example, this is a $20 million loan. They bought a cap, 3-year cap for $50,000. Well, in year one, they escrowed $2,000. In year two, they escrowed $30,000. And now year three, they're having to escrow $100,000 a month. And so, assuming a 6% interest rate, the interest rate payment on 20 million is close to 100,000 a month. So imagine making two payments, an interest payment and a monthly escrow payment of 100,000. And this is pretty much any loan that was done in 2020 on a floating rate loan, because you just have not had enough time to escrow that amount of money. And so we went back, and with some help of some of the guys who put together interest rate cap escrows or interest rate caps for us, we were able to pull like a huge list of all these deals. And I'm not saying all of them are motivated, right? They might have escrow or money in their funds, but think about, all right, let's take this deal, for example. It was $16 million loan, and their strike is about 2.8. So let's just use 3%. So a 2-year cap right now costs $500,000. So they're going to have to basically escrow that amount over the next year off of their deal. And most of these deals, they're definitely not having that much cash flow to pay these caps, right? So this is one of many of these loans on the floating rate side that some of these guys are going to become motivated to either sell their deal or refinance it into a fixed rate loan. All right, so let's get into what we're seeing across, bank loans, Freddie SBL, Fannie and Freddie, and Bridge. Bank loans move the same way as the federal funds rate. So bank loans right now, we're seeing close to 7.5 to 8.5% fixed. Freddie Mac SBL has come down. So 10-year treasuries come down. Freddie Mac SBL sort of moves a little bit slower than 10-year treasury, but 6.5 to 7 on Freddie Mac SBL. Freddie and Fannie fixed at anywhere from 525 to 575. So that's really in line with 10-year treasury, which has helped. So they're about 200 basis points over 10-year treasury. And then non-recourse bridge, anywhere from, I would say probably now, SOFR is anywhere from 4% over SOFR. So you're probably closer to 8 to 10% on majority of the deals. And even we're seeing some fixed bridge options at that 8 to 9%. So you don't have to buy that rate cap. So majority of rate caps right now are costing about 4 to 5% of the loan amount. All right, so recourse bank loan, it's based on prime. It was 7, went up to 7.5 here in December. So 7.5 to 8.5, depending on the size of the deal and the guarantor strength. So we're still doing these loans on smaller deals. I would say under 5 million right now. People are still doing them to get the higher leverage, right? So you can still get 75% leverage on these deals, but you as a guarantor need to be a lot stronger, have a secondary source of income besides the property. This was a deal we did out in Tyler, recourse bank loan fixed for 5 years, and it has no prepay. So majority of the bank loans have either step down prepay or no prepay. So that's a huge advantage if you're going to exit the property. So Fannie and Freddie. So let's jump into Fannie and Freddie. So, they had about 78 billion, this year. And, after I think 10 months, so they have 2 months left, November and December, they were only at about 55 and 51 billion, Fannie and Freddie. So I don't think there's any way they're going to do 25 billion in the last 2 months of the year, just with transaction activity lower. 10-year treasury has come down, but I don't think a lot of those deals are going to make it in their refinancing. And so both of them are expecting about 70 billion total. So this is one of the first times that they've ever not been able to hit their caps. Next year, they're given about 75 billion each, and so they're gonna try to get there. But 10-year treasuries got to stay at 3.5 or lower, and I think there's potential they could get there. In terms of negotiating floors, so if you are doing floating rate, negotiate your floor on SOFR in case it drops out. And then two things: if you have a floater, you can typically refi to a fixed rate, and they will waive your exit fee. So if you have an exit fee of 1%, you could get it waived when you convert to a fixed rate with the same program. So we just closed this loan. This was a Freddie Mac fixed, 3 years IO, 10 years, and I think it was sort of low to mid fives on this deal. We had the 10-year come down pretty significantly during when the asset was put under contract. So, but still low leverage, right? So 50 to 60% is where we're seeing most agency deal size on a 125 right now. All right, in terms of bridge loans, almost all of them are underwriting higher debt yields to make sure they can refinance at a 5.5%, 6% rate. So you're looking at debt yields of 9 to 10%. Spreads are about 4.5 over SOFR. And then we're seeing some fixed rate around 8 to 8.5% on the bridge. But most of the bridge, you're getting probably about 10% more leverage over Fannie and Freddie right now. So 65 to 75%. Here's an example of a bridge loan that we did. And you remember on bridge loans, you're going to get, let's say 65% of the purchase price, but then you're also going to get 100% of the rehab. And so, this was a property that was sort of in Northeast Dallas, and it really needed a lot of work. It was sort of owned by a classic owner, owned by a lot of classic units. The owner had owned it for probably 20 plus years. And so you can see the buyer has come in and really sort of redone the roofs, painted it, redone the outside sort of balconies. And then also, you're going from classic interiors to sort of really a nice new flooring, new countertops, stainless steel appliances, everything to really bring the property up. So if you have a heavy lift, I would say 10 to 15 a door, then this is probably most people are still using Fannie and Freddie, but if you do have a very heavy lift on a 100% classic property, then you might still look at a bridge loan. So how are people moving from bridge loans to agency? If you wanted to reduce your spread, so if you had a 3% or 4% spread and wanted to have the flexibility, you could still go into a Fannie Freddie floater. So it's 225, 250 over, or you could fix. So we're still doing refinances at probably about 5.5 to 6%. Most people are choosing not to go. They're using either a 10-year fix with 7 years yield maintenance or a 10-year fix with a step down prepay. And then you can also shorten up your term. So you can do a 7-year fix with 5 years yield maintenance. So that typically is going to have your spreads are going to be a little bit lower with the yield maintenance, so a lower interest rate, but then your prepayment could potentially be higher. So you just have to make that decision based on how long you plan on holding the property, and we can run those scenarios for you as well. In terms of what we do, we work with general partners on acquisitions, and then we also work with general partners on refis. And so that's definitely during sort of our deal support piece of it. But then, a lot of these deals that we've closed, whether it's asset management, loan servicing, those things, people call upon us to help them. And then also before deals. So going out, touring deals with people, trying to figure out what the best option is for them, and sort of being second set of eyes on these properties. And then, every year, every quarter we try to do something fun with our investors. And so in December, we had our holiday party. So we had probably about 150, 200 people come out here in Dallas. And we had a caricatures there drawing some people as well. So just having fun networking with all the people in the industry is also very important in this game. So here's some of the properties we closed in Q3. And we'll probably do, 1.2 billion in loans this year at Old Capital. And so definitely appreciate everyone watching. Definitely subscribe to the YouTube channel. If you need help with a loan term sheet, send me an email with T12, rent roll, OM, and a whisper price, and we can get you a term sheet. If you need help reviewing a deal, definitely send it over. We'll take a look at it, give you any feedback on what we think in terms of the debt, in terms of the market. And then if you're just getting started, definitely set up some time to go through your personal financial statement, what your plan is for multifamily, and we can help you sort of on the next steps. And then if you're looking at joining a firm, Old Capital, for example, send me an email with your resume and we'll set up some time to talk from there. So appreciate everyone watching the video. Definitely like and subscribe, and we'll see you next month.